Welcome to Adjusting Entries. So, what are adjusting entries? Adjusting entries are used to show expenses that have been incurred but not recorded, but also revenues that have been earned but not recorded in the accounting system. Adjusting entries are used as the generally accepted accounting principles require accounting systems to show the most up-to-date and relevant information that a business can provide, which is what accrual-based accounting allows for, as it shows revenues and expenses in a more accurate fashion. To understand how to identify which accounts to use when adjusting entries, a fundamental knowledge of debit and credit accounts must be developed. So on the debit side, you can see assets and expenses, and on the credit side, you can see liabilities, revenues, and shareholders' equity, where debit accounts go up when they're debited and go down when they're credited, and vice versa for credit accounts. When I was learning, I made the mistake of using the cash account in adjusting entries. However, it is best to know that adjusting entries will always have one balance sheet account, i.e., asset, a liability or shareholders' equity, and an income statement account, for instance, revenue and expenses, and we'll never use the cash account. There are four types of adjusting entries. On the revenue side, there is deferred revenue, which is when a business receives cash before it provides a good or service, and there is accrued revenue, which is when a business earns a revenue before it has received cash. On the expense side, there is deferred expenses, which are expenses in which a business pays for a resource but has not used it yet, and there are accrued expenses where a business uses an expense and pays for it later. Here's an example of deferred revenue, where a business has received $5,000, but they have only completed half of what they need to. So 6 over 12 times by 5,000 equals 2,500, so that's how you calculate the adjusting entry. And unearned revenue is debited and has a credit balance, so it goes down. And subscription revenue is credited and has a credit balance, so credit goes up. Here is an example of accrued revenue, where a client has paid $5,000 worth of goods on account. So accounts receivable is debited and is a debited account, so debit goes up. And sales revenue is credited and is a credit account, so credit goes up. Here's an example of deferred expense, where a business has paid for $6,000 worth of insurance, but has used up 6 out of the 12 months that it has it. So insurance expense is debited by 3,000, has a debit balance, and prepaid insurance is debited and is credited and has a debit balance, so it goes down. Here's an example of accrued expenses, where weekly payroll is $8,000 for a working week from Monday to Friday, and the business prepares its financial statements on a Wednesday. Salaries expense is debited and is a debit balance, so debit goes up, and salaries payable is credited